Good morning and welcome to the new series on Windows On, our monthly panel of hot economic and political topics from the Conference Board. I'm Ataman Özyıldırım, Director for Business Cycles and Growth Research at the Conference Board, and I'll be moderating a very exciting panel discussion today. Today's focus is on the future of oil and where oil prices are going in particular. It's one of those evergreen topics in any conversation about the economic outlook. Where will the oil prices go? In recent years, oil prices have been influenced by a range of factors. So those factors have included changes in the global demand conditions, upsetting of the fossil fuels markets, the supply and demand and inventories, critical technological changes and disruptions, as well as economic and political societal changes and disruptions have really affected the energy markets, oil prices in particular. In this Window On episode, our panel of experts will help to disentangle many of the factors which determine where oil prices will go in the short term and in the longer term. So some of the questions that we will be looking at are really about the critical issues that are influencing oil prices. What are the short-term pressure points on oil prices? Where will they be heading between now and the end of the year? And what is the role of the US in the global economy? We've seen fracking, the economic strength of the US in this business cycle expansion, and changing policies and politics. So what are some of the influences of all of that on prices? And what about the role of the rest of the world? There are big producers and big users at interplay in these markets. And looking beyond the short term into the future, what determines the future of oil and oil prices? So a couple of tips for our audience as they're viewing this are listed in the bottom center of your screen. You can ask questions and make it an interactive discussion with our panel, and I'll weave those questions into the conversation as we go along. You're able to download the presentation and refer to it later or share it with your colleagues. You can make the slides full screen and using the button on the top right corner of your screen. You can see them better. Although this is not a slide-heavy presentation that many of our viewers are used to. We're really emphasizing the panel discussion and the questions from the audience as well. The webcast is being recorded, and it will be available from the Conference Board website a day or so after the webcast today. And finally, at the end, we have a brief evaluation. We'd love to get your feedback to continue to improve these webcasts. Some of our audience may be joining us to earn credits, CPE credits. In that case, there are some instructions for you here on the screen. We need to validate that you're with us for the duration of the webcast, so we need some information and need you to click on those pop-ups that come up. So without further ado, let me introduce our excellent panel here in the studio, also online. And from my far right, let me start with Timothy Goodell, Senior VP, General Counsel and Corporate Secretary at Hess Corporation. Welcome. Good morning, Tim.
Thank you, Ataman.
Great to have you here.
Great to be here.
And then we have Mark Schwartz, Managing Director in Analytics at SMB Global Platts. Good morning, Mark.
How are you?
Great to have you here, too. And to my immediate right, my colleague from the Conference Board, Economic Advisor, Ken Goldstein. Great to have you here, Ken.
Again.
And online, not last but not least, online we have Sarah Fowler, who is joining us from Oxford, England. Sarah is an analyst in the international economy with Oxford Analytica. So we're looking forward to hearing from our panel. And let's just jump right into the short-term conditions in oil markets and oil prices. And we have a poll question for our audience. So we'll give them a few seconds to kind of review the question, and our colleagues in the studio will put that up. And by the end of the year, I expect the price of crude West Texas to be fill in the blank. And then once we get the responses, we will also go to our panel around the table and online to see what their reactions are. Okay. So we're able to see the responses coming in. By the end of the year, I expect the price of crude oil to be around $7 to $85 a barrel, where it is currently. Yesterday it was $82, today it's $71. So it's hard to track the short-term volatility, but there are certain trends that are at play that we'll be discussing in this webcast. Is it going to be ahead of $85, going up to $100, or go below $70? And there's no one that's betting on it right now, and I think we can close the poll. Over 50%, almost 54% say it'll be around $70 to $85 where it is currently at the end of the year. That's not too far ahead. So 30%, 31% say it will be above 85%. So a third, or close to a third, expect that there's upward pressure in prices. 15% minority thinks it'll go below $70. So let me start with Mark. You are in all of these price data and the supply and demand data. What do you make of these responses? Where is your expectations?
I think our expectation is with the consensus. Not that we couldn't see spikes above that level for a few days, especially on Brent. WTI, I think, would be harder pressed to get above 85. But despite the loss of Iranian supplies, we think that there's going to be a supply growth elsewhere that's going to largely offset that decline, both in non-OPEC and in Saudi Arabia and several of the other OPEC countries. So, we see a balance that can withstand losses of Iranian supplies and continued losses from Venezuela, without the market being fundamentally undersupplied.
Very interesting views there. So you spent a lot of time at ExxonMobil, but now you're on the analytics side. Tim, you're still with an oil company,
yes.
And what are your views?
Well, I've taken a position in the period that I've been in the oil business is really the volatility is something that's very hard to predict what our oil prices are going to be. I agree with Mark that the market certainly would indicate right now that WTI would be low to mid 70s with Brent, trading at $8 to $10 higher than that. That's certainly what the market's saying. But with the volatility, surrounding November 4th and what's going to happen with Iran, if there's going to be how much is going to come off the market, it's going to be 500,000 barrels, it's going to be 1 million barrels. We just don't know at this point who's going to make up that supply. I've seen, Mark has certainly his views, but Saudi Arabia is really the one with the most capacity to make up that supply, and how much they really have to make it up, just don't know in the long term. So for us, it's really looking at a lot of volatility. I think most oil companies like us, we take a more conservative approach on oil price based on what's happened in the last 3 years. And so we are on the more conservative side in terms of our planning.
So but if you guys are right on the supply side, and there's not that much that's going to happen dramatically on the demand side, what's going to prop up prices at this level, let alone spike it higher? Why wouldn't it spike lower?
We're talking about pretty significant losses in Iran and Venezuela.
Which you said you think can be made up relatively easily.
I think we can be made up so that we aren't in a situation where we're drawing down stocks. But we don't, in our most likely, given a realistic assessment of what the Saudis can do to offset Iran, we don't see a build in stocks either. We don't see a return to price weakness.
So Sarah, how about you at Oxford Analytica? What are your predictions for oil prices, and what do you see as the driving factors under that prediction?
So we see oil towards the upper end of the $70 to $85 range to the end of the year, with the supply constraints dominating in the short term. 3 quick to highlight: the US sanctions on Iran's oil exports from November. We see that cutting at the moment oil supply, global supply, by 1 million barrels a day or more, because neither the US nor Iran looks likely to make major concessions at the moment. We also see risks from the US hurricane season to hit US output in the near term. And similarly to the other guys, we also see Libyan output volatile and Venezuelan output is falling. That's going to continue to be a supply constraint dominating.
So it seems to be there is a little bit more upward pressure than going back down below.
On the supply side.
On the supply
Well,
side.
I think on price, you clearly have to, there's, upward pressure. If you're going to bet one way or the other, it would be on the upside, in my view.
But there are a lot of factors.
Based on supply.
Supply and demand, and also the political, factors are going.
See, I buy your argument on the supply. I just don't see where the demand is that would support that kind of a
Demand,
spike.
if you look at the IEs, are growing 1 million, 1.5 million barrels a day. I think Mark will say it's even higher than that for the next 2 years.
Despite all the talk of weakness in demand, we're looking at the strongest 5-year period of global demand growth that we've ever seen. Now, obviously, that's all contingent on continued economic growth. If you think are going into a recession, then all bets are off. But if you think we're going to avoid a recession, and so far we don't see any of the signs that normally precede the recession, we're looking for another year of 1.6, 1.7 million barrels a day, and we have non-OPEC supply growing faster than demand. So, in our view, the world can tolerate some net loss of OPEC.
See, I think that's, to me anyway, that sort of is the central argument. That if global growth stays about where it is, roughly, maybe even drop off a little bit perhaps, but certainly there's not going to be an upward spike on the demand side. So that all of these questions about what happens on the supply side, yes, they can have the impact on the price, but it's all, I think that the swing factor, therefore, is on the supply side, not on the demand side, either on the supply side or on the financing of all of this.
Yeah. So there are many factors that are affecting prices, and it's economics, but also politics and geopolitics, beyond the economic factors that we look at. And then also, as we see, there are different opinions on, how the oil prices are formulated. So the real performance of the economy matters. Is economic growth as good as it gets now? And even if we avoid a recession, is there a lot more demand created? Financial markets matter. There's what's going on, stock prices and currency markets have an influence. So Mark, what do you believe is the most important here? Both generally for the markets and also particularly at this time, what's at play?
Well, our view is you always start with the fundamentals. If you're in a world where supply growth exceeds demand growth and you're building up inventories, clearly you're going to have downward pressure on price and vice versa. But, there is no doubt that for short periods of time, what the financial community does matters. We saw that back in 2008, where, there were strong fundamentals, but probably not justifying $150 a barrel, which we saw at its peak. And yes, if the speculative community decides that they want to be long, for a short period of time, that can be the most important driving factor and can certainly lead to overshoots, perhaps, of where the fundamentals will take you. So yeah, we think that we keep a close eye on what the financial community does, and yeah, they are also tend to be very sensitive to political risk development. So if the Saudis are a little bit slow in increasing production once Iran sanctions volumes are down, if Iran talks about retaliating against other suppliers, either directly or through their proxies, the financial community could react very quickly, and you could see a little bit of a spike.
So you keep an eye on it, but do you think that they can influence the medium-term trajectory for oil prices?
I would say more the short-term trajectory. I think the further you go out in time, the more important fundamentals are.
That's great. Thank you. And Tim, you might have a different perspective on this. You sit in the general counsel's office, right, and in an oil company. So what do you think about these changes?
Just to comment a little bit on Ken's on the demand as well, because you got to remember, I think, as Mark said, demand's growing 1.5 to 1.7 million barrels a day. But you got to remember, there's also natural declines of about 3 million barrels a day. So really, what you need to make up.
Where does that decline come from?
from the natural wells declines.
Okay.
So you got about 3 million barrels there. So you're really making up about 4.7. So if you look at what shale's producing today at around 5 million barrels a day, you got to create another shale, production to be able to offset, these natural declines plus the demand growth. So it's quite huge. And you got to look at it we look at it obviously in three ways. You've got what we consider the long cycle. So shale is about 5 million barrels a day, 5% growing maybe to 10 million barrels a day. Some say 12. But that's about 10% of the overall production. So where's the other 90% coming from? You've got long cycle, 7% is that it's deep water. Deep water is 7% of global production. That's long cycle, and that takes about 5 to 6 years from FID, or first, basically first investment. And what's significant is that over the last 3 years, the underinvestment there has been phenomenal. The IEA says you need $540 billion a year to keep demand basically flat, to meet demand. The last 3 years, it's been woefully below that. So I think last year it was $420 billion, $350 billion before that. So you have a major gap. So long term, you're gonna have to fill that long cycle demand well. And then you have the third one, which is the swing oil, and that's coming really from Saudi Arabia. Has the most spare capacity, as Mark mentioned.
Mm-hmm. How important is the short-term volatility for those long cycle investments?
Incredible long term, because you're making billion-dollar investment decisions, looking forward onto oil prices. So you've got to have a lot of comfort. And after the hits that the oil companies took over the last 3 years, very cautious in terms of making those investment decisions.
So you really have to consider many different factors that are going in.
Factors.
I would just add, it takes a lot of nerve to make these multi-billion-dollar upfront investments in a world where the industry is being told that oil demand is going to peak, and boards and shareholders are worried about stranded assets. So but yet I agree totally with Ken. People look at non-OPEC, non-shale, and see it flat and say, well, that's not much of a contribution to it. But that on a net basis, on a gross basis, you've got to be adding several million barrels a day of new supply to offset decline.
Ken?
Yeah, I absolutely. And there's one more factor, and that is with these billion-dollar investments that have to go on for the next 10 years, with all of this short-term volatility today. The other factor, or a other factor, is the cost of borrowing. So right now, and it has been for the last couple of years, basically the price of money has been close to dirt. It's been so cheap, and it's still cheap, but it's going to start to rise, and so that the financial burden, the debt service to all of this debt is going to start to rise. That's an added cost. How are they going to be able? How are you guys going to be able to recoup some of that cost? What does that do to the price? What does that do to the consumer who's paying that price, who doesn't want to pay that higher price, doesn't understand how come we can't go back to the cheap prices of 2-3 years ago? So you've got those kinds of tensions as well.
So Sarah, what is your take on these factors?
So, in terms of the general health of the economy and the impact on the oil price, next year I see demand as more important. And I think the risks could shift towards $60 oil being more likely than at the moment people thinking $100 as an upside risk. I think weaker trade and investment flows could dampen demand next year more than people are seeing at the moment, potentially.
Thanks for sharing that, Sarah. It's when you put so many economists in the room, you do get different views. But maybe it's time to kind of move to our second topic for the hour, which is what is the role of the U.S.? And there we have another poll question going to our audience, and the team will put that up. And so fill in the blank. I think the role of the United States as the key driver of where oil prices will be heading in the next 12 months will be to increase, stay about the same as it is today, or decline. So we have the results coming in. So the role of the United States will increase, stay about the same as it is today, or decline. Of course, the U.S. has been in the forefront with the fracking revolution, a big game changer in oil markets. So let's see, we'll give them a few more seconds. Maybe in 5 seconds, let's close the poll. And the majority, 58%, think it's going to stay about the same. So no major changes in 12 months. 41% though expect an increase, and no one expects a decline in the U.S. role. So the U.S. of course is on the world stage as an oil producer now, not just a source of oil demand. So let's go to our panel again. Mark, I'll start with you, kind of responding to that question and what you see in the results.
Well, it depends what you mean by role here. The U.S. has been the leader in supply growth, except in the year when we saw the price drop, in which case it led the decline. But as far as its role in providing incremental supply to the market, I think that's likely to decline over the next 12 months. We're already starting to see signs of infrastructure limits in getting oil from the Permian to market. You're seeing that as a discount on Permian price. And we think that problem will be addressed as additional pipelines are put in place, but that's probably not going to happen until towards the latter part of 2019. So we think, while the U.S. absolute supply will continue to grow, we think that rate of growth is going to be slower over the next 12 months.
So Sarah, what do you think about the role of the U.S. From across the Atlantic?
Well, I'm perhaps more bullish on the US output. Although OPEC's estimated to have 1.66 million barrels a day of spare capacity, it's not clear how quickly this can come on stream. So I think once the hurricane season is out the way, the US role, although there are the problems with the Permian Basin and the delivery, I think the US has more potential to increase its production than perhaps Saudi and some of OPEC can definitely fill the entire Iran-shaped gap. So I would see the US role increasing modestly.
Sarah, for sharing that. And Ken, what are your reactions to what you're seeing and hearing?
Well, short term, absolutely, I agree. But I think if we look a little bit longer term, you have all of the stuff that we were talking about before. Can you make the investment? Can you afford to make the investment? Can you get a return on that investment? I think there's one more factor, though, that we haven't even mentioned: renewable energy. Is that just a niche, or is that really going to take a larger role?
Well, we think renewables is going to play a large and growing role, but mainly in electric power generation. We will have some small amount of growth in biofuels, but so by and large, we see renewables having a very potentially large impact on coal and natural gas, but really not much of an impact on oil. We're not burning much oil in power generation, and a lot of the growth as time goes on becomes in petrochemicals, where we're not seeing, well, there's some potential for renewables, but not a lot. So, until we get to the point where we have significant penetration of electric vehicles, which is a ways down the road, we see the renewables as more of a threat to the other fossil fuels than oil.
So you don't see battery stations replacing gas stations anytime soon?
Well, it's going to it's a whole other topic, but when you look at, a electric vehicle share of new sales at under 2%, and a share of the on-road fleet of at well under 1%, that transition, even if you're fairly optimistic, is going to take a while.
And Tim, how do you respond to that, and where do you see the role of the U.S.?
Well, just back to the point on the question on the role of the U.S. is I agree with Mark. That in the short term it depends. If you're really talking politics, it's going to have a significant role, because whether the U.S. wants to force the sanctions or give some exemptions along the way, that's going to have a big impact short term on oil price. But as I mentioned before, when you look at the U.S. price and hurricanes aside, because that's really, again, Gulf of Mexico is more affected by hurricanes than onshore, That's really the longer cycle. So that's in the next 12 months, not going to really have any impact on production. What we're really talking about is the tight oil shale production, which is, we said, was short cycle, 6 to 12 months. You just can't turn it on and start moving oil. You need to hire rigs, contract with rigs, get rig drilling crews. We need frac crews in place. So that takes 6 to 12 months before you start going to generate any kind of production.
Assuming you have the takeaway capacity.
Well, then you have the bottlenecks. We're in North Dakota, so we're not faced with those. But in the Permian and West Texas, they're certainly faced with significant bottlenecks. As Mark said, until those pipelines are built to try to get the export oil, they're talking about probably the end of 2019.
And those bottlenecks with the pipelines was a big topic at the sort of outset of the game-changing fracking revolution. So it's still with us, right? Yeah. They're not solved.
No, I mean, they tend to be short-term. Industry, especially if you're building pipelines in Texas, permitting is not normally a problem there. The problem will be solved, but periodically you will run into these constraints.
Mm-hmm. That gets back to Tim's earlier point about the shortfall in investment, that we just simply haven't put the money into building this stuff so that we get rid of those bottlenecks, or at least minimize them.
Again, we're talking about only 5 to 10% of what's the world's production. So how do you invest in the other 90%? And those are the ones that are real long cycle.
Yeah. So Tim, there are probably two elephants in the room, so to speak, no pun intended, when it comes to the role of the U.S. When looking at the global oil prices. So one is the sort of the fracking industry, major role. And the other is the U.S. administration's desire to keep low prices. And we just heard from the president at the UN yesterday talking about keeping prices low. How do you weigh those two factors in terms of their importance for what comes next?
Well, it's very hard for us to weigh the two factors because it's kind of contrary to each other. If you want low oil prices, then you don't put sanctions on Iran in the short term. That has a big impact on that. And as we said, there's how much spare capacity there is. Sarah says one and Mark says others. That's really a question of how you're going to deal with that loss of supply in the short term. Longer term, obviously, as Mark said, the economy is very strong. That's obviously a positive thing for oil prices. Fuel prices are very affordable. If you look at today, I think 42% of the cars that are sold today are SUVs. They're not the fuel efficient cars. So that bodes well for oil prices. But then the oil has a huge impact on the economy in the United States over the last 10 years. So there's been about $600 billion of investment from oil companies alone. It's employed directly and indirectly over 10 million people. So that's a huge impact on the economy. The trade deficit, because of the oil exports today, has had a huge benefit for exports, for the trade deficit as well. So overall, the stronger economy, the better the oil prices are within a stable range. We look for oil stability, which is best for, we think, the oil companies because it encourages investment, but it's also good for the economy.
So low oil prices are, of course, underlying the high consumer confidence that we're seeing as well. And the price being low is important, but the stability of the oil prices also.
Yeah, if the oil prices are too low, people aren't going to invest because, again, we're a public company. Most oil companies, public companies, or they have investors that say that we want returns. And unless you're going to make a return on it, people aren't going to invest, and that's going to impact production in the long term.
Yeah, those are difficult factors to balance when you're looking at it. So the next question is for Mark. There's a new book by Bethany McLean. It's called Saudi America, The Truth About Fracking and How It Is Changing the World. Saudi America. She argues that the fracking industry could actually become the next trigger for crisis, because there's a huge amounts of debt being built in this industry, but the industry is fundamentally unprofitable. So because of the very different nature of fracking versus deep sea long cycle industry, the business is characterized by the quick deterioration of the wells. So what are your thoughts on that? Is it a potential trigger for crisis?
We don't think so. There is certainly a grain of truth there. It's a diverse industry. There may be some companies that are financially weak, that are over leveraged, but this industry has evolved quite a bit over the last couple of years. 2 years ago, I might have been a bit more worried when prices were lower, when companies seemed to be driven by cash flow as opposed to, by volumes rather than cash flow and profitability. But a lot's happened over the last year. For one, the price has gone up. And I think when people talked about break-even prices in the low 40s for U.S. shale, I think to some extent those were well break-evens and really were not, those were not prices that would keep a company in business, covering all of their overhead and land acquisition and other costs. We think the break-even was always fundamentally higher than that. But at $60 a barrel, we believe that the industry will show positive cash flow this year. So, anything above that is going to allow them to pay down debt a bit more. Yes, it's true that we do have these very high decline rates for the first couple of years, but we also have a long tails on these wells. At least we believe we have long tails on these wells, so that over time you've got maybe 10% of the original production, but with very low costs associated with it, that should be a positive contributor. So I think while it's true that we've got high decline rates, if you're looking at the fundamental health of the business, you've got to take into account that a lot of cash is going to be thrown off eventually by those tails as well. So we would have been more worried about this a couple years ago than we are now. There's been restructuring in the industry. Some of the smaller players are gone. More of the acreage is in the hands of fundamentally sound companies. So, while there'll be sporadic problems, we don't see the industry as being fundamentally unprofitable.
Thank you for that. That's very insightful. But before I go to the next question for Ken, I'm going to poll our experts here whether anyone else sees a trigger point from the shale industry, the fracking industry for the U.S.
Well, I agree totally with Ken. I mean, it's back in 2015, 2016, the public markets left between debt and equity probably $50 billion. Private equity put about $10 billion in there, and last year it was about $7 billion. So it's fundamentally changed from a production growth, that's what all the investors wanted, to show me the money. So instead of drill, show me the money, and they're looking for free cash flow today. So that's put a lot of discipline on the oil companies in terms of how they're going to pace the drilling. Yes, they are, rapid declines, but as Mark said, they flatten out over time. So the shale companies today in the tight oil is you're constantly drilling new wells. So we see is again oil production from tight oil about growing from 5 million to 10 million and then flattening out, but then for probably 20, 25 years. So
Great.
It maintains that production.
Great, thanks. And Sarah, let's go to Sarah before going to Ken.
Sure, and I think the focus of some of the US LNG projects will shift from new projects to improving existing projects and making the infrastructure around the projects that have already been built are good enough to support the higher exports. So I think you will see that shift from kind of new to existing over time.
Thanks, Sarah. And so, Ken, how do you react to that trigger for crisis?
Well, I'm not sure that it's a trigger per se, but I think there's another shoe that we haven't talked about. If there's a uniform price across the board, there's not a uniform cost from this field as opposed to that field, A, and B, that the cheaper oil to get out is already out. So where we are, whether we talk about shale or whether we talk about crude, what we have to get out now is more expensive. And you were talking earlier about the offshore. Offshore is more expensive than onshore. And it depends about how deep you have to go. So let's talk just for a second about, the cost pressure, especially on those folks whose fields are more expensive to operate as opposed to, let's say the cheaper, easier fields.
So I think you break it down into two areas. One is obviously the tight oil onshore, which clearly it's not just within the field, but within the field there's different economics. So what we call, we believe in North Dakota we're in the core of the core, as we call it. So it's all about the rock, as we say in the industry, and it's really where the key core areas are in the play. Then if you look at offshore, yes, the economics are different, as we were talking earlier, is obviously between the Gulf of Mexico, in deep water Gulf of Mexico, where costs are significantly higher than other parts, Brazil, where we're operating now in Guyana. very different economics in terms of what you break even costs in terms of the prices. So that impacts your investment decision as well. But cost is also coming down. So obviously as people, oil companies will innovate. So they'll bring their costs down. The cost of drilling a well in the Bakken was 6-7 years ago, $12 million. It's now down below $8 million to drill and complete. We're seeing in the deep water now, so the supply costs are significantly coming down, where you had drilling rig costs of about $600,000. The day rate's about $600,000. They're down to $150,000 a day. So the costs are significantly
Over what time period did we
over the
go
last 3 years. So
In 3 years, we went from 600 to 100.
the day rates of the deep water drilling rigs, yeah.
Wow.
No, it's a big impact on the supply. Obviously, other costs are coming down, as well. So that makes the economics obviously better. And so when you're looking at those projects, obviously it all changes. But as Mark said, you got to still take a pretty significant and healthy view about what oil price is going to do, because if it's going to take you 5 to 6 years to build that project, from the time you make that investment decision or board makes the investment decision, you've got to have a lot of confidence in oil price.
We're actually seeing two different trends in costs. In the case of shale, after several years of decline, we're starting to see it bottom out and maybe even start to increase.
Which is no big surprise.
No, because the activity's up and costs are up. But in the case of deep water and the non-shale projects, we're seeing that continue to come down. I think there's a lot of companies out there, the majors, the big state oil companies, that have realized that either they figure out a way to get those deep water costs down, or they're going into liquidation long term. So
Because you can't make money otherwise.
yeah, it's going to be difficult for the majors to grow their business on shale. I mean, they're really going to need a continued selection of these very big projects if they want their volumes to grow.
And remember, nobody's investing right now in the deep water, not only in projects, but in exploration. If you look at the oil industry today, the investment in exploration is down over 50%. So people aren't exploring today. People are getting out of the exploration business. So if you're out of exploration,
because they don't think there's any more to find, or
no, because it's not. They got to generate returns. So
okay.
And remember, the history in the industry is maybe 1 out of 4 exploration wells, wildcat wells, are successful. So it's and if you're drilling wells in the Gulf of Mexico at $300 million, it takes a lot of confidence in the well to do that.
Of course, we could talk about the U.S. oil market until midnight, but we do have to move on. What about the rest of the world? So I'll start with Mark. Outside the U.S., of course, there's the usual suspects on the supply side, like Saudi Arabia, Iran, and Russia. What do you see their influence on the oil market going forward?
Well, I mean, for the next several months, the world's eyes are going to be focused on how much does Iran have to cut, and we think it's going to be fairly substantial. We think the sanctions are going to be extremely effective, with major cuts in Europe and Japan, and at least modest cuts, or certainly no increases from India and China and other countries. How Saudi Arabia reacts to that? Are they quick in increasing their production to try to at least partially offset those losses? Again, the world's going to be very focused on those month-to-month Saudi numbers. Outside of OPEC, yes, we do expect Russia to increase. We expect normal increases of a couple 100,000 barrels a day. And beyond that, if you look at where the big contributions will come from outside of the U.S. and OPEC, Brazil is set for quite a few startups over the next year. Canada, despite this view that Canadian oil sands isn't going anywhere, year after year we continue to increase the number of or the amount of output coming from Canadian oil sands projects, and then bits and pieces elsewhere. So as I said, we think that total non-OPEC growth next year will be well above 2 million barrels a day. This year it may hit 2.7 or 2.8.
Are you optimistic about Brazil? I was recently there, and there was a lot of pessimism about the Brazilian economy, lack of confidence in the ability to do the investment that's necessary, especially oil.
I mean, we've never taken the government or Petrobras estimates at face value. We've always discounted them some, but even with discounting, there's enough projects that are in the works that at least for the next year or two, we think the production increases are very real.
So it could be a wild card. And Mark, thank you for setting up the Iran sanctions topic, which I'm going to ask Sarah about, because Sarah, you've been looking at the risks there, and you have this nice chart. What do you see in terms of their influence on oil?
Sure. So we see India as the biggest question mark. It took nearly 20% of Iran's oil exports last year, and it's going to struggle to diversify its supply, its imports from Iran. So we see it as the country most likely to reach some concessions with Washington, and we could see Washington reducing its pressure on India to comply. And South Korea, on the other hand, has already agreed its revised trade deal with the US. So it's much more likely to be under pressure to be fully compliant. It's also got a waiver on the steel and aluminium tariffs on the basis of agreeing to supply certain quotas to the US. So it's got much more riding on keeping relations going there. So we see India as the biggest question mark in the case of Iran. Europe is likely, at the moment we see, to pull ties. China, much more likely to maintain some trade with Iran.
Thanks, Sarah. Any reactions to that?
I don't know if you saw the announcement this morning, whether it's true or not, but India's not buying, their November barrels from Iran. So if they're buying 577,000 barrels a year from Iran, and Iran's producing about 2.5 million barrels a day. Sorry, then that's 25%, and that's a huge impact and surprising, quite. But my view is, I think the U.S. is going to be. Trump seems, after his speech yesterday, pretty serious about enforcing these sanctions.
Yeah, I think if you look at the certainly our estimate of how effective the sanctions will be has grown. We're looking at cuts of 1/6 off the peak by November, and I think the consensus has gradually taken more and more Iranian barrels out of their forecast.
The big difference between sanctions today and coming up in November and what it was 5-6 years ago is the impact on the financial markets, because the teeth that they're putting in these sanctions today, companies can't afford to take a chance on violating the sanctions, because they won't have the financing available to them through the financial institutions to be able to go out and finance ships or whatever it may be to get the oil, from Iran to India.
And that would apply to U.S. and non-U.S. companies.
Anywhere in the United States, anywhere in the world. Sorry.
Ken, any thoughts?
No, I just, we talked a little bit earlier about who's the swing on the supply side. Would you guys agree that on the demand side, it's India?
I think China and India are the two. I mean, if you look at going forward, and Mark's better than I am on this, but they're looking at about 50% of the demand growth going forward in the world is India and China.
But China can do something India can't. They don't want to, but if they had to, they could go back a little bit to coal. India doesn't have that option.
They're already in coal. They're building a coal plant a week right now, so they're significantly into coal. So they've got to do everything, all the above.
All the above.
Well, speaking of swing producers, there's of course Saudi Aramco, and this question, Tim, is to you. The IPO of Saudi Aramco made big news, but now it seems to be off the table. It's on again, off again. The largest oil company in the world. How do you see them evolving?
Well, obviously they're state-owned companies, so they're really what we're talking about. Saudi Aramco, we're talking about Saudi Arabia and what their production is. So the timing of the IPO, that really ties into their Vision 2030. Really, it doesn't really have an impact on the global oil supply, unless you may disagree.
No, it doesn't have a short-term impact.
I don't think it has an impact at all. So.
Even longer term.
Even longer term.
Interesting.
Well, Saudi Arabia has to maintain their government budget, right? So.
Well, that's part of their Vision 2030, diversifying their economy. But yes, obviously. Saudis, but like all the OPEC countries, they have significant amount of social needs, and so they need a price of oil, just like oil companies need to generate free cash flow. They need to generate the cash flow to fund their budgets and their social budgets.
Yeah. So I have a demand side question for Sarah. The key players on the demand side are, of course, Europe, China, and India. Now we're putting U.S. in the suppliers category. How do you see the influence of those big demand sources on the oil markets right now and going forward? So we've been kind of projecting a long soft fall in the Chinese growth rates, and that came up as a swing demand country. Does that lower Chinese trajectory affect the global demand for oil? And what about the other demand sources? Sarah?
But I think reducing pollution is a major government priority for China. I mean, the news came out today that they've increased their target for the share of renewables in their energy consumption by 2030 from 20% to 35%. But we agree with you that it's certainly going to be a long and soft transition. China liquefied natural gas demand has been growing very strongly last year and into this year, and demand's not going to fall off a cliff there. It is going to be a very kind of gradual transition. So China is still going to be demanding a lot of fossil fuels for a long time. I also agree with you that India is going to become a bigger and bigger player. Among the major economies, it's going to have the most rapid GDP and population growth over the next 10 years.
Thanks, Sarah. I often get the question when I do talk about the economic outlook on, okay, China is slowing, but India is the next sort of largest country with very high growth rates. Wouldn't India be able to kind of substitute for the shortfall in demand from China? What do you think?
Well, to a limited extent, I think, in the medium term, because India is at the moment very dependent on its coal-fired plants, and that's going to take a long time to transition away from that. So I think if we're looking beyond kind of 20, 30 years, then yes, we could see that transition to India compensating for slower China, but I don't see that happening in the next 5-10 years.
Yeah, it's very difficult to substitute a big chunk like China, even with slower growth rates. It's such a large part of the world economy and integrating into it. So
again, if you look at the IEA forecast, they're looking at China and India being about 55%, of global demand. So
yeah, still the major source of demand. Yeah. And Ken, what do you think?
Well, I think there's another wild card, not over the next 6 months, maybe over the next 6, 10, 20 years, and that's Africa. And not just the fact that Africa may start to grow more, but Africa is going to be, if they do, they'll be developing their infrastructure, their industrial infrastructure, as opposed to their service sector. And of course, industry uses more energy than does services. So a wild card, again, not immediately, but over the next decade or 2 decades, could well be if Africa ever gets its act together.
I agree, and that's what IEA forecast, I should have been clear, is not just Asia Pacific region, but it also includes Middle East Africa in terms of that 55%, and that compares to 25% for North America and Europe combined. So in terms of driving that demand, that's going to be coming outside of the United States.
See, the other, and not just Africa, we could even talk about Latin America other than just simply Brazil. It's not just the growth in their economies, it's not just the growth in their population, but the increase in their urban population as opposed to their rural population, which again adds to the demand. So, none of that's going to happen right away. None of that might not happen for 10 years. But again, when you were talking earlier about how you really have to take a long view, especially with respect to your sinking fixed cost, there could well be some payoff down the road, not just in India as opposed to China or vis-a-vis China, but also what happens in some of these other places that we often don't even talk about.
Well, this may be getting a little bit into the longer term as well, but I agree. And, it's very easy to become pessimistic about the prospects for long-term demand growth. Every day there's articles about electric vehicle penetration and bans on internal combustion engines. But quietly, as you said, not just the urbanization, but, the world is moving, somewhere between 80 to 100 million people into the middle class every year, much more than they used to. And, with that, It doesn't show up in newspapers. Nobody reads about it every day, but that's such a powerful force for what does middle class mean? It means you can afford to buy a car. It means you may be taking your first airplane trip, and all of the things that come along with that middle class lifestyle. And it's a very powerful upward force for energy that, it'll be offset by fuel substitution and efficiency, but it's a lot to offset.
Even if it's just a refrigerator or a washing machine.
Exactly. Yeah.
So that's a great segue to looking at the longer term about the future of oil. What are those longer term trends? And let's throw another poll question, our final poll question for the hour, to our audience. And oops, I don't think we have a slide for that. That one asks, I expect that by 2030, the role of the oil in global energy supply will be significantly decreased, be about the same as today, or it will further increase. So let's see if people expect that by 2030 the role of oil in global energy supply will have declined, be about the same, or increased. Okay, the numbers are still changing, so we'll do them a few more. So I'll be asking our panel about what their thoughts are. Let's close the poll in a few seconds. Give them 3 seconds to make up their minds. Here we go. So the majority, 78%, think that it will be about the same as today. And that's perhaps because 2030 isn't really not that far away. Significantly decline is chosen by 14% people. So about the same or less. And then the minority think that there'll be a greater role for oil. Of course, that's probably because of the new renewables that are coming online and alternatives out there. So let me go to our panel to react to that. Mark, what do you think?
Well, we're in the business of putting out these outlooks. So let's just take a look at the fuels. And I would say my answer is, if you're talking about as a fraction of energy, as a proportion, we probably will see a moderate decline. And the reasons, we expect oil and transportation to be affected by both the efficiency improvements and some beginnings of alternative fuel penetration, electric vehicle penetration. Natural gas use will probably grow faster than oil as it plays a role in backing out coal. Renewables will probably be the fastest of the fuels, wherever possible. Nuclear is a mixed bag. You're going to have these dramatic differences between very strong growth in China and declines in almost all the industrialized world. But overall, we would expect oil growth to be faster than coal, slower than gas, much slower than renewables.
And Tim, how about you?
Yeah, so we, again, looking at the IEA numbers, they're seeing demand growth, through 2040, actually, in oil, but as a percentage, as Mark said, it's going to decline to about 30%, of the energy mix, by 2040, according to the IEA numbers, and Mark has his own. The other thing you need to look at, I know, Ken, you talked about countries, but you also got to look about sector. So what do you have? You've got, yes, light-duty vehicles that could go electric, but what's going to drive it? Airplanes. There's no substitute for airplane fuel right now for oil. Heavy-duty trucks, long-distance trucks. There's no substitute really right now for that in the long term. And then the third item is petrochemicals. The demand for petrochemicals in this world and the plants, and those are driven by oil. So those three factors really don't have a substitute. And even under the IEA numbers, going to 30% of the energy mix, they're assuming even if half the vehicles in the world are electric vehicles, it's not going to change that number significantly.
Everybody in West Virginia is cheering what you just said.
That's a coal country.
Yeah.
That's also a petrochemical country.
Well, it's all over the United States. So look where petrochemical plants are being built today, all over the United States.
But not New Jersey anymore. I absolutely agree with you. I think, even if you take in the exotic factor like the driverless car, I don't think that that's going to change the mix all that much. So it pains me to agree with these two really smart guys.
So, Mark, one question for you. I mean, you see the proportion maybe slightly decreasing. Do you think that there's a role in that kind of a world for new producers coming online? We hear about sort of the Eastern Mediterranean bringing on new sources and supply.
You're talking about oil or gas, natural gas?
Or either one, I guess.
Well, in the case of oil, absolutely. We also still have, ever declining growth as we go out past 2030, but we don't really hit a peak through 2040. Agree, the mix is going to change. Crude oil is steadily going to be a little bit less important with the growth of petrochemicals, which may be leading the oil complex 10, 20 years down the road. A lot of that is going to be supplied by LPG and ethane. Natural gas is interesting. You've got a couple areas, including the United States, where it's going to be very difficult for some of these new projects to compete with expansions of existing projects in the U.S., which are going to be fundamentally lower cost. The Qataris are once again talking about another round of expansions. I think for other LNG projects to go forward, they're going to need some advantage, either high liquids content or it's especially low cost gas, because it's the U.S. and Qatar and to some extent Russia and Australia are pretty well positioned competitively.
So there's a first mover advantage. And Sarah, so the other factors that affect this mix are, of course, coming from renewables and substitutes, but also climate change. Would you like to address either of those?
Sure. So renewables, I agree that they will far outpace fossil fuels growth over the longer term. Slowing the transition, the key constraint at the moment is solutions needed to increase reliability of renewables are not all there yet. And I think as they come on board and technologies advance in the next 5-10 years, that's really going to help renewables gain much wider adoption. Quick word on climate change. While other countries have redoubled their commitment to the Paris Agreement despite the US withdrawal, earlier this month the UN Secretary General warned that only a third of the action needed to meet climate change targets, the Paris commitment actually fulfill that action. And he estimated that by 2030 the productivity loss would be $2 trillion to the global economy. So I think that tells us that also some attention to plastics pollution and the environmental impact, there is going to be a lot more redoubling down on climate change targets, increasing them, which could impact oil more over the next decade.
Thanks for sharing those insights. And Ken, thoughts?
Yeah, well, maybe one last question, and that is, with all of this projection, so you guys don't see the demand to lessen the carbon footprint is going to be able to have that much of an impact to decrease demand of fossil fuel?
It's going to be difficult to hit the good news is, if we believe our balance is mainly because we do believe that while oil may not be hitting a peak, we do believe that global coal use could be hitting a peak over the next 10 years or so. And so, yes, we can see a world where the growth in carbon emissions slows considerably and maybe begins to decline. It's very difficult with current policies and current incentives and current technology to see a world where
U.S. policy or world policy?
Well, even world policy,
Okay.
to hit the 2 degree targets.
And Tim?
Yeah, no, and we certainly agree with that. I think, again, the IEA scenarios they put out there, that's under the new policy, so that's taking into account Paris and everything else. So it's still, as Mark said earlier, it's going to slow the demand growth, but it's not going to eliminate it.
Immediately, I absolutely agree. Longer term, pressure could build to move faster. Pushback is, what do you want us to do? What can we do? But I think that's some of the tension, not short term, but longer term, that could develop.
Unfortunately, we are almost at the end of the hour, but I have one last question with request for a one-sentence answer. We'll start with Sarah. And the question is, do you see any new technologies or innovations in the oil markets that will change all of these things that we've been talking about? Sarah?
Well, I think biomass technologies and green gases could grow faster than current kind of baseline scenarios expect over the next 10 years, and that could change things in the renewables space.
Thanks, Sarah. And Tim?
Absolutely. Oil companies are innovating with, every single day. If you look at this whole tight oil revolution, it's all been about innovation in the industry, and they'll continue to innovate to drive costs down and improve efficiencies, capture global gases, methane and others that are, harming the environment.
And there's more to come then.
More to come.
And Mark?
Well, we're looking very, very closely at electric vehicles and the technology and the policy incentives, but it's got to be an economic proposition. It can't go in with subsidies alone, and it's got to be economic and competitive on the other amenities, on fuel recharging availability and recharging time, and it's really got to be a better vehicle than internal combustion engines to really take over the market.
So complex issues that require a lot of innovative thinking. And last but not least, one sentence, Ken.
Game changers are the ultimate unknown unknowns.
Yes.
The unknown unknown. So let's leave it at that. And I want to thank our panel with us in the studio and online, Sarah Fowler from Oxford, Tim, Mark, and Ken. Thank you for joining us. And thanks to our audience for listening in and sending us questions. We value your feedback. Please fill out the evaluation at the end. And join us next month for looking at political risk analysis, the outlook for 2019. Questions and comments, you can write directly to our chief economist, my boss, Bart Van Ark. You have his email there, and you can sign up for the future Windows On programs. Thank you very much, and have a nice day.